Welcome to Countouts. In this lesson, we're going to be looking at inventory. We're going to be looking at what is inventory, how is it recorded, what is classified as inventory, and how it's recorded in the financial statements. So hopefully after this lesson, you should be able to know inventory very well. So what is inventory? Inventories are goods held for sale in the ordinary course of business, that is, the merchandise for sale or what the business usually sells. It's also goods that are in the process of production in order to sell, and that is what is known as work in progress. So if the goods are in the process of production, we call them inventory as well. It's materials used in the manufacture of products, and these are raw materials. So for a company that provides materials, those materials would be classified as their inventory. It also supplies or materials consumed in the normal course of business, like stationery, which would fall part of inventory. You also have what is called consumable stores on hand, what is remaining at the end of the period. Those are what will form part of what inventory is. Now that we know what inventory is, let's look at the classification of inventory, which is very key to understanding inventory well. Well, the intended purpose of the asset is key to determining whether it is inventory or something else. And that is very important. What is the intended purpose of the asset that you have? If an asset's purpose is held for sale in the ordinary course of business, it is classified as inventory. And that's also very important. So what I've highlighted here in red, the intended purpose is what will determine what it is classified as. So if the asset's purpose, if the company is buying assets, if their purpose is to sell it in the ordinary course of business, then the company will classify it as inventory. So let me give you an example, because inventory for one company may not be an inventory for another company. It's the intended purpose which will determine whether it's inventory. Let's look at an example of two different companies. The first one we're going to look at is BMW. What does BMW have? Well, the company has BMWs, and we're talking about cars here. And the second company we're going to look at is a rental company like Bidvest Car Rental. What do they have? They also have BMWs. Now, what will these two companies classify their cars as? Well, for BMW, what's their intended purpose for having the car? Well, their intended purpose is to sell those cars. So BMW produces cars so that it can sell them. Now you can see what is highlighted in red. If it's held for sale in the ordinary course of business, it is classified as inventory. Therefore, this car that you see here, BMW will classify it as inventory. But what about Bidvest Car Rental? What does it do? Does it buy BMW so that it can sell them? No, that's not the intended purpose. They buy these cars so that they can hire them out. That means they will not classify these cars as inventory. What will they classify them as? They will classify them as property, plant, and equipment, or what we know as PPE. So what you can notice here is that whatever the purpose is for having that asset will determine what you classify it as. Don't forget that. Always look at the intended purpose. Now, let's look at how cost of inventories are derived. According to IAS 2, the cost of inventory should include the cost of purchase net of trade discounts received. What we are saying here is that whatever cost you will include as the cost of your inventory should not include any discounts you have received from your supplier. So the cost include transportation, taxes, and handling. That's very important. So whatever transportation you used to bring your inventory to your warehouse, and your taxes and your handling, that will form part of the cost of inventory. And just as a side note, VAT or VAT does not form part of the cost of the inventory. And we've looked at that in another lesson, how you record inventory when you're buying them and when VAT is included. You'll find the link to that lesson in the description below. What else form part of the costs of inventory? Well, the costs of conversion, which include variable and fixed manufacturing overheads. These costs will form part of the costs of inventory according to IAS 2. Another one is other relevant costs incurred in bringing the inventories to their present location and condition. So these will be what forms part of the costs of inventory. What methods are used to determine the costs of inventory? Well, there are various methods which are used, and here they are. Various methods may be used to determine the cost of inventory. Different values are obtained depending on the method used. Some common methods are the first in, first out method, or the FIFO method, and we've done a lesson where we went in great detail on how to complete the cost of the inventory and the cost of the closing inventory and the cost of sales for the inventory using the FIFO method. You'll find the link to that lesson as well in the description below. Another method for determining the cost of inventory is the weighted average cost method. We have also looked at this method before. You'll find the link to that lesson in the description below. Another method that is there is the special identification method that is used in some instances or in some cases. And one thing we know also, we have another one which is called the last in, first out method, or the LIFO method. But this method here is prohibited under IFRS because of potential distortions on a company's profitability and financial statements. Because the last in, first out method states that whatever inventory you bought last will be the one that you sell first. And what does that mean? Obviously, the one that you bought last will usually, or in many cases, be the most expensive because of inflation and other factors. That means it will reduce your profits, and by reducing your profits, it's going to reduce your taxation. So you can see the distortion that might be there on a company's profitability and financial statements. And what does it mean? The inventory that remains in your balance sheet or in your statement of financial position will be way lower than what it is in reality. Those are some of the reasons why the last in, first out method is prohibited. Now, what inventory systems are used to record inventory? Well, here they are. We have the perpetual inventory system, which is the most common system today because of technology and how inventories can be tracked. The perpetual inventory system states that for every transaction relating to inventory, we have to record it. The movement, any movement of inventory is recorded. And here's an example. Let's say you buy inventory from your supplier. What is your debit? What is your credit? Well, here it is. You will debit the inventory because inventory is an asset, and you will credit bank if you bought the inventory using cash, or you will credit the accounts payable if you bought the inventory on credit. That is how you do it using the perpetual inventory system. Now, we've done extensive lessons on the general journal for recording them under the inventory systems, so you'll find the links to those lessons as well in the description below. Another method is the periodic inventory system, and as the first word says there, periodic, inventory is updated at the end of specific periods. So whenever you purchase inventory, the same example as before, what will you record? You will not record inventory, but you will rather record purchases, and you will debit that, and then you will credit bank or accounts payable depending on how inventory was purchased. And only at the end of the year or at the end of the period will you update the inventory based on what you have in your storehouse. Now, those are the two popular inventory systems that are used, and like I said, the most common one is the perpetual inventory system. Now, how do you disclose inventories in the financial statements? This is another important factor. How do your inventories affect your financial statements? So let's look at that. When inventories are disclosed in the financial statements, they are measured at the lower of cost or net realizable value. At the lower of cost and net realizable value, whichever one is the lower one, either the cost or the net realizable value. The net realizable value is the price that may be obtained for a product and the deduction of the estimated costs necessary to make the sale. The net realizable value is often lower than the cost if the product is damaged or obsolete, and by obsolete you mean out of date. Now, how is inventory recorded in the statement of financial position, or otherwise known as the balance sheet? How is inventory recorded there? Well, inventories are recorded in the statement of financial position as a current asset. Now, we know that inventory is an asset, but what asset is it? It's a current asset. Why current asset? Because we sell it in the ordinary course of business. We sell it very frequently. It's not a non-current asset where you expect to have it for more than 12 months. So it's recognized, or it's recorded in the statement of financial position as a current asset. And here is how it will appear in the statement of financial position. We have an example here. This is how the statement of financial position looks. And where do you have your inventory? Well, here it is. It appears under current assets, and you have the inventory there with its amount. That's how it's recorded in the statement of financial position or the balance sheet. The method of inventory measurement and the composition of inventory are indicated in the notes to the financial statements. Now you have the recording of the inventory in the financial statement, but you also need to explain or indicate what method was used to measure the inventory and the composition of inventory. And here's an example of the notes to the financial statements. You have here, number 1, accounting policy, and then we are told that the accounting policy of Villa Cargo, which is the name of the company, for example, is consistent with that of the previous year and is as follows. And you have 1.1 inventories, and you're told for inventories that they are measured at the law of cost and net realizable value using the first in, first out method. And then you can see another note here, number 4. This is how it should be recorded. Inventories consist of, and we are told what inventories are consisting of. So if you have an inventory, whether appears in the statement of financial position or the balance sheet, let's say for 100,000 Rand, and then here you give a note, what does that inventory consist of? And here you can see it's written merchandise, or the actual inventory, or the trading stock, and consumable stores. These are the consumable items which have remained at the end of the year, and you can see we'll be given here the amount. This is how inventories will appear in the notes to the financial statements. How do you disclose inventories in the statement of comprehensive income? Well, inventory sold is recorded in the statement of comprehensive income as cost of sales. Very important to take note of this. Inventory is recorded in the statement of comprehensive income or the income statement when it is sold, and it's recorded as cost of sales, and sometimes it's known as the cost of goods sold. And that is where inventory would appear in the statement of comprehensive income. It's only for the inventory that has been sold that should appear in the cost of sales. And here's an example of the statement of comprehensive income, and where is inventory here? Inventory sold would form part of this cost of sales. So you have sales here, and this is for the sales of your inventory, how much sales you have made. And then under the cost of sales, you will record the inventory that you have sold, how much it costed you for the inventory that you have sold. That is how it should appear in the income statement or in the statement of comprehensive income. Now, how do you account for inventory in the statement of cash flows? How does it appear, or how is it recorded? Well, the difference in inventory between the current period and the previous period is recorded in the statement of cash flows. So now you can see how inventory affects each of the statements. In the statement of financial position, we mentioned that you record the inventory that you have, or the inventory that is remaining in your business or in your storehouse. And in the statement of comprehensive income or the income statement, you record the inventory that you sold during that period. You record the cost of those inventory. And in the statement of cash flows or the cash flow statement, you record the difference in inventory between the current period and the previous period. And this is how it should appear in your cash flow statement or in your statement of cash flows. Where would you record inventory? You would record it over here. And you can see we are recording only the increase or the decrease in inventory between the current period and the previous period. So if you have the inventory at the end of the current period and the inventory at the end of the previous period, the difference between the two would be recorded in the statement of cash flows. Now, if the inventory has increased from the previous period to this period here, if it has increased by 20,000 like we see in this example here, we put it as a negative in the statement of cash flows. Why do we do that? Because we assume that you bought inventory, and by buying more inventory or by having more inventory than you had in the previous year, you spent money to buy that inventory. And if inventory has decreased in the statement of financial position from the previous year to the current year, then we'll put it as a positive in the statement of cash flows, because we assume that you sold more inventory. That is why you have less during this period. So the statement of cash flows merely records the movement of cash alone. Now, we have done these 3 statements in separate lessons in great detail. We have done the statement of financial position or the balance sheet, the statement of comprehensive income or the income statement, and the statement of cash flows or the cash flow statement. You'll find the links to those lessons as well in the description below. And I hope you have gained value from this lesson. I hope you now know what inventory is, how it's recorded, what methods are used to determine the costs of inventory, what systems are used, and how they appear in the financial statements and the notes to the financial statements. If you have gained value from this lesson, please subscribe to our channel, like this video, and share it to those you think it might help. Till next time, cheers.